Fixed versus variable, an age-old debate. There should be little debate once one understands they're not actually just making a single bet on rate. Nope, there's a second bet being made, a much higher stakes one and a much riskier one that very few people think about because very few people actually know about it. And this bet relates to mortgage penalty, but first we'll talk about the rate. So the first bet, as I say, relates to the first and, sadly, often the only question asked, what's the best rate? Is there a rate advantage to going to variable? The reality is that the net rate difference between a 5-year fixed and a 5-year variable, however great or small, means very little. Why do I say that? Because while one may think that mortgage is all about mortgage rates, the reality is it's actually more about the mortgage payment, because that's what comes out of our bank account at the end of every month, or the end of every week, potentially. A skilled mortgage broker will advise us on more than just rate. They'll talk about the different policies of a variety of different lenders, and maybe a product such as a variable rate mortgage with a static payment, because such a thing does exist, which would mean that even if prime were to move up or down a quarter point, or perhaps up a half point or 3/4 of a point over a period of time, the monthly, or again, better yet, the weekly payment actually remains the same. So the payment doesn't always move in a variable rate mortgage. So the thing is, bet number one on rate, it's less of a concern, especially when one looks at history, in particular recent history from 2008 to 2019. 2008, we had that major economic crisis, and it took almost 10 years for prime to climb its way back up to a meaningful number from there. So given what we're currently going through at the time this video is being shot, June of 2020, we're not looking at prime increases anytime soon if history is any indication. So if mortgage rates aren't what we should base the decision entirely on, what are we missing? Well, enter bet number two. The bet that you don't even know you're making most of the time. And bet number two hinges on a second question, a question rarely asked. What if I break this mortgage early? What happens if I break this mortgage early? And you may not think that you will break it early. In fact, few of us ever expect to break a mortgage early. I know I didn't. And yet we do all of the time. Consider just a few things, along the lines of this. 96% of businesses fail inside 10 years. Odds are that you're employed by a business or that you own your own business. So keep that in mind. 96% fail in 10 years. 60% of marriages fail inside 10 years. Are you engaged, just married, or well past that 10-year mark? Either way, life happens. Now, not to be all negative, many good things in life happen as well, like twins, surprise, or triplets, even bigger surprise. But also good things like work promotions, work transfers to a new province. Oops, can't port that credit union mortgage from one province to another. Didn't think about that at the time. Or to a new town, maybe a smaller town. That seems to be a popular topic of discussion right now, moving to a smaller town. And that smaller town, maybe it's a rural property, which some lenders don't like to lend on. Maybe that rural property is on well water, which was a problem I had back in 1995. So if that mortgage is broken early, and roughly 2 out of 3 people do break their mortgage early at an average of about 33 months, so inside 3 years, what happens? That's the key question here, right? So let's talk in dollars, because what happens is dollars leave your pocket. That's what happens. So the average Canadian mortgage balance today is about $400,000. That's typically what we're seeing as a median mortgage in Canada. And the prepayment penalty, if in a 5-year fixed mortgage with a major chartered bank, the majority of credit unions, and increasingly the majority of all mortgage lenders, on a $400,000 mortgage broken at, say, 33 months, for instance, that penalty would be approximately $18,000, or 4.5% of the balance. Same as it was, incidentally, back in 1995 when we triggered our first and last interest rate differential penalty, or IRD penalty as they're known. A lot of people say, oh, wait, my mortgage only has a 3 months interest. No. The fine print in 5-year fixed mortgages says the greater of the 3-month interest or the interest rate differential. An interest rate differential is like $100 set of words to spell out approximately 4.5% of the balance. And that 4.5% number, it was the same in 95, as I mentioned. It was the same in 2018 when I shot the first version of this video. It's the same today. I mean, exactly today. I just had a penalty cross my desk that was basically 4.6% of the mortgage balance. So this is still ongoing. So what about the variable rate mortgage? What's the penalty to break a variable rate mortgage? Well, 99% of lenders will only charge a 3-month interest penalty at the actual interest rate that you're paying on that mortgage, which equals about 0.5% of the overall mortgage balance. In other words, that same family with a $400,000 mortgage would only pay a $2,000 penalty to get out of a variable rate mortgage. So now what kind of risk factor are we really talking about here? That's a $16,000 bet that someone has placed without even realizing it. When you take a 5-year fixed mortgage, especially through a major lender, without really thinking things all the way through, what kind of changes could happen in my life, you're basically placing a $16,000 bet that you're going to make it the full 5 years through that mortgage. Because if you break it early, and no kidding, no exaggeration, in some cases you break that mortgage a day early, a week early, a month early, you're triggering that massive prepayment penalty. So don't be focused on rate. That's just the one thing. And let's talk a little bit more about rate. Are we in a rising rate environment? Well, we seem to be back in 2018 when I shot the first version of this video. But certainly we don't appear to be now. Are we in a falling rate environment? Well, for most of this year, no matter what kind of mortgage product you were looking at, yeah, rates continually were coming down. But what about right now? Look, the easy answer is it just doesn't matter. All right, but I'll give you more than that. As I touched on earlier, it took 10 years for prime to climb back up from its rock bottom lows after the hammering our economy took back in 2008. Why would we be expecting to recover any faster this time around? And even if prime were to increase a full 1% next year and say another 1% the year after that, which is exceedingly unlikely given the history of the 2008 crisis, for 2 out of 3 clients who've broken that mortgage at 33 months, they're ahead by thousands of dollars anyway, even if prime were to increase. And if prime remains flat for the next 2 to 3 years, then they're ahead by tens of thousands of dollars. People fear rates rising. People fear losing a few $100s per year. Next year, if prime increases, maybe even a few $1,000s, despite all indications that prime will not increase. Yet somehow people don't fear triggering a $16,000 greater prepayment penalty. This is a massive hit, and it's a double whammy because the 5-year fixed interest rate historically has you paying more interest along the way. So you pay more interest to pay a higher penalty. Ouch. What we should really fear is the one thing that we all fear, and that's the unknown, which is to say we shouldn't really be fearing anything when it comes to our mortgage because there should be no unknowns, no secrets, no surprises. Don't get caught losing a massive piece of your assets, equity, 3 years from now. Don't get caught by the unknown. Ask questions, ask your broker. And remember, life is variable. Maybe your mortgage should be too. Thanks.